Assalamu alaikum students. This is the second course of second lecture of the Assalamu alaikum student. This is the second lecture of international monetary system on the second week of your online classes. So in today's lecture, we will, since in the last lecture, we basically just covered the concepts, the basic terms like exchange rate system, the balance of payment system. So in today's lecture, we'll start exploring the international monetary system. How does it work? What it is? And we'll talk about the fixed, flexible, and managed exchange system that actually determines the international monetary system. We'll talk about the history of international monetary system. So we'll start from the gold standard system. We'll briefly cover that, and then we'll talk about the Bretton Woods system, and finally the current system, in which currency board system is another important term that you will study or learn today. So before I explain to you the the structure of the international monetary system, it is important to understand what is the objective of international monetary system is. So international monetary system is basically a set of institutions, laws, norms, regimes, which are created with the purpose of facilitating international transactions. So imagine if there is a transaction between citizen of one country with another country. International monetary system ensures that this transaction happens smoothly because both citizens have their own currency system in their own countries. So international monetary system ensures that when they are doing trade or any sort of transaction, so it happens smoothly without an issue of without any problem related to the difference in exchange system, difference in currency system. So for instance, the exchange rate we studied in the very last lecture. One of the most important job of international monetary system is to determine how the foreign exchange rates are set and how government can affect the exchange rate, whether they can or whether they cannot. So in history, there were three different exchange rate systems, historically speaking. Yeah, or three different ways in which the foreign exchange was set, and that mainly decides the structure of your international monetary system. The first method or way of setting foreign exchange is a fixed exchange rate. And a fixed exchange rate is when governments set official exchange rates, and they defend the set rates, the predetermined rates, through intervening in the foreign exchange market. Gold standard or the US dollar based Bretton Woods system, they're both the good examples of fixed exchange rate. The second type of exchange rate is flexible or floating exchange rate. In this monetary system, governments do not usually intervene in the foreign exchange market. So the exchange rate or the currency rates are determined based on the supply and demand laws, based on how market is operating. And there was one small point that I missed in the last lecture. The exchange rate system are basically determined based on the balance of payment. If there is an imbalance in the in your balance of payments, so exchange rate try and adjust that. And since there is no ideal floating exchange rate system in the world, mostly governments do intervene in the monetary system. And this concept of floating exchange rate system is basically more theoretical rather the real world thing. And finally, we have a third method of setting exchange rate, and we call it the managed exchange rate, which is basically a hybrid of the two system, the floating and the fixed system. In this system, governments buy and sell foreign currencies, and they develop monetary policies like increasing interest rate. And all these monetary policies and purchase and selling of foreign currencies, it indirectly influence the exchange rate. And if you can recall the factors I explained in the last lecture that affect the exchange rate, so country basically try and use those factor to manage exchange rate while keeping it flexible and subject to change with respect to supply and demand. So in summary, there are three systems: fixed exchange rate system, which has a predetermined exchange rate; a flexible exchange rate system with the volatile exchange rates based on the balance of payment; and a hybrid managed exchange rate system, which technically is flexible. It changes with respect to the balance of payment, but governments can indirectly intervene to keep the rate fixed. Before the World War One, the international monetary system used a fixed exchange rate, and we used to call it the gold standard. And this gold standard developed gradually. So it was not a global exchange rate system and the international monetary system. And it was not used continuously as well. It was used on and off from 18th century till World War One. In this system, each country defined the value of its currency in accordance with a defined amount of gold. So, for instance, US dollar in 1879 was equal to 23.22 fine grains of gold. And since currency at that time was in gold and silver coins, so these coins were made in accordance to the assigned value of the gold and silver. The fixed exchange rate for different currencies were determined by the gold content of their monetary unit. And since we are to study the history of international monetary system since Bretton Woods system, as per our outline, I'm not going into much details of the gold standard. The most important thing for you to remember is that it was a fixed exchange rate and it worked till the World War One, but then it was replaced with a flexible monetary system. And I'll explain to you briefly why it was changed. When World War One started, the governments needed to finance their military expenditure, which was massive at that time during because of the World War. And they started printing money and without taking care of the gold standard. So because before that, following the gold standards, the governments needed to print money in accordance to the gold rate, to the equivalent of the gold. But now that since they needed money, so they started relying more on the paper money. And as war ended, the situation was so bad that they could not restore the gold standard. First, the manpower had been reduced because of the war, and the inflation rate was peaking. It was very high, so prices of products and services were very high because there was no labor available, and the inflation rates were already high. So also under the gold standard, the countries were using British pound as a reserve currency. And now you need to understand the concept of reserve currency. So a reserve currency is basically a hard currency, if you remember the concept of hard currency. State banks all over the world hold this reserve currency in their reserves. And the purpose of holding and the reserve currency is to keep the exchange rate fixed with respect to that particular currency, that particular hard currency. Since that currency is hard, it means that the country, which was UK at that time, British pound was the main currency, reserve currency at that time. And UK was believed to be able to convert its pounds reserved in the Bank of Pakistan or Germany or any other country into gold. So whenever there was a fluctuation in the exchange rate, the country, the bank, the central bank of any state, was able to exchange that reserve with gold to keep the exchange rate fixed. The account deficit in the UK that occurred after the World War One, it cautioned a lot of countries because they now knew that UK might not be able to convert the pounds they were holding into gold. So this again resulted in the damage to the gold standard system. The country were not willing to return back to the gold standard system because they lost their confidence on the British pound. Finally, while some countries did try and implement the gold standards after the war, the Great Depression that happened after it made it almost impossible. The hyperinflation in Germany that happened during the Great Depression, and I've discussed it in the previous offline classes when we were studying the international trade system. This hyperinflation made it almost impossible to restore the gold standard. And then World War II happened, and the international trade, international transaction almost ended. All the monetary transaction were limited to the country. And when came out of that Second World War, then it was felt that one prime factor behind the Great Depression was that there was a floating exchange rate system, and there was need to stabilize the world economy. So if you can recall, when you were studying the history of international trade system, I told you how US eventually agreed to end its isolationist policy, and in 1944 um, all major economies of the world, they sat together in Bretton Woods, and there they decided to restore a fixed exchange rate system. But this time, knowing well the problems they faced with the gold standards, they adopted a two-tiered system. So each country established its exchange rate with respect to dollar, US dollar, and the US dollar standardized its exchange rate or currency value with respect to gold. So it was decided that 35 US dollar will be equal to 1 ounce of gold, and all other currency were fixed and with respect to the US dollar. And it was the US government responsibility to manage the fixed international exchange rate because it was the only currency that was supposed to be exchanged with the gold. In addition to this, the Bretton Woods created an organization, an institution, and they called it the International Monetary Fund. IMF. The job of the IMF was to use contributions from member countries and to offer reserve credits to states with the developing economies which were facing international payments problems. So to ensure that they maintain their exchange rates at the fixed values, at the predetermined values. Now, this system, this monetary system of fixed rate, which lasted almost till early 1970, it was quite successful. It was very successful because it was a mix of a fixed and a flexible system, and I'll explain how. So it allowed the domestic policy autonomy and international monetary stability both at the same time. It provided a compromise between the rigid gold standard, which was a purely fixed system, under which governments had very little ability to manage their economies because they cannot, printing money would not affect that system. It was entirely focused on gold, and gold reserves are fixed. And as a result of this, there was very limited ability for the governments to intervene in the foreign exchange system. And then, on the other hand, there was a full floating system, which led to kind of a monetary anarchy in 1930s, where governments had too much power and they started engaging in competitive devaluation of monies. And so, it was somewhere in between the two, because in addition to uh, pre-deciding the values, the current exchange rates of each currency, the Bretton Woods system understood that some countries' balance of payments would noticeably change over time. So IMF was given a responsibility to re-evaluate the exchange rate of currency with respect to gold in situations of fundamental disequilibrium. So fundamental disequilibrium is when there is a notable change in the balance of payment. Member countries were entitled to borrow from IMF up to a certain limit, and that limit was its regular contribution to IMF. Beyond that limit, the IMF can lend a certain amount, but it is conditional upon the borrowing countries accepting the IMF conditions, IMF surveillance over its policies. So it is important to understand that IMF is not a lending institution. IMF, this lending practice was basically just to temporarily give a push to the dying economies, and IMF was to ensure that the monetary policies of the country are revised so to return back that amount. Now, in 1960, the world economy was booming, and there was need to increase the reserves, but those reserves could either be gold or dollar, and there were limitations in the supply of both. Gold is a natural material; it's not like printing notes, so its supply is limited. And even if you have the money to purchase gold, if there is no gold in the market, you cannot purchase it because it's not available. The second option was US dollar, and the supply of US dollars depends highly on how much it is being printed by the US and whether the US government is actually willing to invest abroad or not. Also, the price stability was the job of the US. So, outflow of dollars for the US meant that uh, constant outflow of dollars would make us one day unable to redeem in gold in the agreed rate of $35 per ounce. So the whole system depended largely on the confidence countries showed toward the US dollar, just the way it was in the gold standard when countries had confidence in the on the British pound. When Vietnam War started, that confidence was shaken because inflation rates got high in the US, and the US government, in an attempt to hide the financial cost of the Vietnam War from the American people, they did not increase the taxes, and they chose instead to pay for its for all the warfare and welfare policies through inflationary macroeconomic policies. And they adopted certain very, very controversial monetary policies, which were later criticized as efforts by the government to re-elect Nixon, because Nixon was the president at that time, and he tried in his attempt to re-elect himself in the upcoming election. He adopted certain very controversial monetary policies that dismantled the whole global monetary system, because the entire system was connected with was packed with the US monetary system. Then, because of these problematic policies, the American trade deficit started, and this American trade deficit resulted finally in the Nixon administration decision, which was made on 1971, August 1971. They finally decided to devalue dollar, and that the US government is no longer redeeming dollars for gold. So it eventually ended the Bretton Woods system. And the US also made another important uh, decision at that time. It tried and forcefully made other European countries to appreciate their currency, so to devalue the US dollar. And in this way, I mean, the appreciation of European currencies and the automatic devaluation of the US currency, it created a flexible exchange rate system. So the fixed exchange rate system that was created under Bretton Woods system was replaced by a flexible exchange rate system. After the collapse of the Bretton Woods system in 1973, while allowing their currencies to float against the dollar, the European Union countries decided that they needed to narrow the extent to which they can let their European countries' currencies fluctuate against each other. So these efforts basically culminated in the birth of euro in 1999. The When we talk about the current exchange rate system, the current international monetary system, it is basically based on a hybrid exchange rate system, and the United States, European Union, Japan, United Kingdom, Switzerland, Canada, all the major economies of the world, they follow an independent floating policy, but they do intervene at with certain limitations. There are some countries which use a fixed exchange rate system, and the fixed exchange rate system popular in the current international monetary system is called the currency board system. And the currency board system is when a country it's explicitly announced that it is exchanging its domestic currency for a specified foreign currency at a fixed rate. And so it is so currency board system, and the country is free to decide which foreign currency it will use as a standard. Hong Kong at present follow the system. Some small European countries like Bulgaria follow the system as well. Pakistan follows a floating exchange rate system, but as I mentioned earlier, there is some indirect government intervention to keep the currency from depreciation. So if you follow the business page of the newspaper, you'll be aware of some news which came in the late in 2019 and in the early 2020, because the value of money is constantly depreciating. So there were some news that the country might start intervening in the exchange rate system. However, the state in itself, the state bank, has repeatedly confirmed that it will follow a floating exchange rate system. So this is today's lecture, and tomorrow I will share some pages of Gilpin's book. Would read that, and inshallah, we'll have a regular class on Thursday. Thank you.